So, okay, let's get started. So before I get into our model, so I want to have a sort of a short overview or summary of what I call centralized versus decentralized option pricing. So what do I mean by centralized option pricing? This approach is pretty much what we are all familiar with. That is, we start by specifying some security price dynamics and then take risk neutral expectation on the payoffs. Then the dynamic specification plays the role of centralization. It centralizes the pricing of all option contracts, and it guarantees concession consistency, right? Because everything is written or priced based on the same dynamics. It's like a reference. So everything is automatically consistent with each other. And this approach, you start with the black merchant shows as sort of the starting point. So then we have adjuncts like the Merton models, the gas default like the Heston model, and then various combinations of jumps, the gas default, right? And Peter and I have also worked in this modeling approach for a long while. We have this time change levy process to generate the various combinations. I feel like I'm getting pretty good with these models. But what I realize is that when you start to get marginally good at something, you feel very confident. Like you have a model, you price the options, and you see it fits some market, it doesn't fit some other market. And when it doesn't fit, you say, oh, the market is stupid. I have a model, it doesn't fit, market is wrong. But then as I get better and better with this modeling approach, I start to become suspicious of myself because I worked on this option desk. So in the end, whatever the trader brings to me in terms of an implied about future, I can write down a model on the spot to capture that future, no matter how weird that future is. Right. So even worse is that for every feature he brings, I can specify at least 2 different dynamics to generate similar pricing performance. Okay. So, but even though the pricing preference is the same, so I cannot really differentiate them in a sense for a fitting. But their hedging implication can be very different. And we did this large scale backtesting for an option market making platform. It works reasonably well. The pricing, as the interpolation, generating some errors. But I find to form the portfolio, it is actually more stable or more robust using the Black-Scholes grids as the risk hedge than using my model. I have this fancy jump diffusion, the gas default model. If I use that to calculate the partial derivatives, it seems to work, right? But not as robust as the Black-Scholes model. Although I know the Black-Scholes itself is wrong in many different ways, right? So even also you look at these markets, like different groups. In our pricing group, we use this fancy model mainly for interpolating, getting pricing errors. But there's a whole different risk management team, and they're not going to take our model. So they manage our book, right, in a sense, still using Black-Scholes grids with some modifications, right? We have some bargaining, saying, for different buckets of Vega, different from the other buckets, something. But it's still, we're using completely different sort of frameworks for the pricing versus the risk management. Okay? That's sort of where I feel like I'm getting so good with these models, and suddenly I can fit anything. And I don't know what that role of the model is anymore. And what is decentralized option pricing? So about 10 years ago, we started this. So we start with the black merchant model, but we're no longer using that model as a bottom-up pricing model that is, assume a geometric rounding motion process. Instead, we're using that model as a representation, value representation, to summarize the risk sources of a single contract. Right? Each contract, you can use one implied vol to match the contract price, very much like a bond price versus yield to maturity. Right? Each yield to maturity matches the price of that particular bond. Right? You can link it to other bonds. Here, you can link it to other options, but there's no structural linkage. Everyone calculated separately implied vol. Right? So this is a single sort of match. Right? And then you can, based on that representation, we can derive a pricing formula by matching the time decay with its gains from other risk exposures, more like just guaranteeing no dynamic arbitrage between this one contract and the underlying security. But since it's derived based on this one contract, and if you want to price another contract, you need a new derivation. Maybe the formula looks like the same, but it's completely two separate prices. So they have no direct linkage, okay? So I'm thinking about it as I'm writing the slides. I'm thinking this is somewhat similar to the machine learning stuff. That is, you choose a very simple basis function. So the Black-Scholes model here serves as a simple basis function, right? Like a local sort of function. But you use localization. Each function is for one contract. Obviously, you can fit anything, that kind of thing, right? So here the issue is not flexible enough, but rather identification, because the time decay of the contract can be balanced by gains from several risk sources. So you can juggle many different ways. And you cannot identify all of these things based on one contract. And so what do we do in this paper? We're trying to sort of hold these two things together. And if you try to think about it philosophically, centralization versus decentralization is almost like a wave, right? Over time, people stress decentralization like now, right? Decentralized finance, whatever. And sometimes you focus on centralization for information consolidation, decentralization for flexibility. It's more like going back and forth. Here, we're trying to sort of pull them together, build a bridge between it by centralizing decentralized pricing. How do I centralize them? We start with the decentralized pricing of a single contract, like what we said using the Black-Scholes model, right? And then based on that one, we calculate what we call the break-even contribution of each risk source based on historical moment estimators of the risk magnitude. If you think of the contribution, you can break them down as risk exposure, like the Black-Scholes, all this gamma, vega, those kind of stuff, times the risk magnitude, right? If it's vega times, I guess, the variance of the vol or something, right? So that. And normally when we do pricing, we use some risk neutral moments, right? The risk neutral pricing. But here I said, okay, let's use some statistical historical moment estimator. The beauty of this Black-Scholes representation is the risk source are either return or the implied vol, both are observable. It's not like instantaneous variance rate or something. So it's observable. You can just use history of implied vol, history of return to get some variance covariance estimate, right? It's observable. And that gives me a anchor or starting point of break-even contribution. I remember that this risk magnitude, risk source are different for different contracts, risk variation are different. The magnitude of these estimates can also vary across contracts because this implied vol is different from that implied vol, right? So these are very, very contract specific, and each one is estimated by itself, right? You allow all kinds of variation. But then we said, okay, to bring the break-even to the actual pricing, right? The actual price can be higher than the break-even price or lower, depends on whether it's priced at a discount or premium. Then we can add a premium or add a discount on each risk source, right? You have all this resource. You can either add a premium or discount. We don't know what, right? But we assume that for all the contracts, we should add the similar amount of, proportional amount or something of a premium or discount, right, per risk, right? So in a sense, the first step guarantees the dynamic no arbitrage between that contract, each contract and the underlying, right? That's the standard thing. And the second step is less of a structural no arbitrage argument, is more of a statistical thing, right? It's assuming that these risks are similar. It's like an apple, apples. They're not the same apple, but they're all apples. And each apple, the per apple price should be similar. Right? That's more like maybe APT, right? Statistical arbitrage. We say volatility risk across different assets should be priced the same. Credit risk should be priced similarly, that kind of thing. Right? So we'll apply that to sort of link all contracts together. And so here are some details. Right? So what's the starting point? Starting point is for each option price I, each option contract I, you use the Black-Scholes equation to summarize this risk in terms of the option value changes with calendar time, with the underlying stock price, and with the underlying implied vol. And here in principle it's ST, right? I put I because I want to use forward everything. I also want to use all forward value to just hide the interest rates, dividends, those kind of stuff, right? So everything is forward to forward option price against forward stock price, security price. So the forward security price in principle can be different for different maturities in a sense, right? So that kind of thing. The formula is just cleaner. It doesn't have any other purposes. It just hide all the financing rate in a way. Right? So for this representation, you can say these are the real random risk sources. And these are observable, right? We observe this forward price movement, we observe the implied vol movement. And that decentralized in the sense that this implied vol thing is per contract, it's on that contract, right? It's not an instantaneous variance, it's like a factor thing. This is just a per contract quantities. Right? So we can estimate the moment estimators based on the history. Okay. Given this, you apply sort of, you take the partial derivatives, right? Get a Taylor expansion in a sense to get what I call the P&L attribution, the forward price change in the option. You expand them first order, second order term. Suppose we stop at the second order, assuming diffusive dynamics for the next instant. And that's our decomposition. Normally, I also normalize the security price to 1 or 100 so that the P&L becomes excess return. Excess becomes excess return on notional, right? Notional like it is option price change over the underlying security. Right? So if I take expectations, I get an expected notional return. So you take expectation under the risk neutral measure, set it to 0, you get this relation, which is essentially a pricing relation because all these partial derivatives, are known because these are Black-Scholes formula. It's like the yield, duration, convexity stuff. These are Vanna, Volga, Gamma, Vega. These are all known formulas. Theta, these are all known. And all of these things are the risk neutral expectation of the variance and covariances, right? The mean, variance, return variance, vol, percentage vol variance, and covariance, degenerate return, and vol change, right? Under the risk neutral measure. The issue, this is a pricing equation, right? No arbitrage says this thing has to equals to 0, this equation has to be priced. The question is that the issue is that this equation has so many terms, it's very hard to be identified by itself, right? And it all applies to one single contract. So you have to do some sort of polling to be able to identify them. And originally, Peter and I, we assume that all the implied vols, they're different contracts, sure. But we assume they have common dynamics. Right? The W is the same, M is the same, although I occurs different I in the same, right? By assuming that, we're pulling them together. But what we find is that they're not exactly moving the same, right? For example, the short-term implied vol tends to move a little bit more than long-term implied vol. And actually, in that paper, we try to add some time decay, but I'm not even sure that's kosher. The question is, can you add a time here for a contract? Right? We don't know how that works. But it's sort of a stretch, but it simplifies things. It pulls everything together, right? And there's this working paper. I'm not sure you can find it anymore. And I think some industries also using it, but they're hiding it. I also recall there's a guy who posted the SSRM paper, but soon the HR pulled it out. So it's related to this sort of topic. So what they starting point, at least what they do is they perform a regression per maturity. They're assuming these variance covariance stuff are the same per maturity. So you run the regression per maturity. And normally you pick 3 contracts to fit these 3 things because these 2 cannot be separated per maturity. I think, see, the theta and the vega have pretty much the same except maturity. So when you fix maturity, they're not separable. But I guess you can still run regression on these 3, assuming this is 0 or something, to get sort of a smile fitting in that sense. And some extensions along those lines. Okay. And a more recent paper Peter and I did is that we assume more vaguely that is nearby contracts should share similar contracts. What does it mean nearby? That is, if the strike very close to each other, maturity very close to each other, the implied vol should be close too. It's like the yield curve should be smooth, the vol surface should be smooth. So that kind of thing. It's not a quantitative assumption, there is a qualitative one. But it's less for centralized analysis, more for local identification, more like a local linear regression, right? Local identification kind of thing. And also I have this hedging with nearby contracts. It's the same concept. That is, forget about complicated models. If you use very similar contracts, you hedge with each other, you remove most of the risk. The hedging ratio is also very simple. But you don't need a fancy model to calculate hedging ratio. Hedging 1 month contract with 10-year contract is hard. But hedging 9-year contract with 10-year contract at similar strike, it's easy. Sort of it's safe, that kind of thing, right? It's less model dependent. So that's that idea. Okay. But all of these assume some sort of commonality on the dynamics, right? So in this paper, I say no. So we don't assume commonality on dynamics. Actually, we take the dynamics as input, right? So we estimate the dynamics as input without imposing any commonality, right? So we use historical moment estimators, right? And since these historical moment estimators as inputs, if you have better estimator than historical moment estimator, say you have a forecasting stuff, I'm recently writing a paper on forecasting stock return variance. The reason I do that is if I figure out better ways of forecasting these things, we can directly use it in these pricing models. It's separate, right? And remember that these moment conditions are per contract. So they could be the same or they could be completely different, doesn't matter. And remember the centralized jump diffuse stochastic law model can price the option well, but it doesn't capture variation very well. Here, the variation is embedded in the pricing to begin with. So I take that as the starting point and then compare to actual pricing by adding a premium, adding a discount. Right? Just assume that the premium discount is the same thing. Right? So this idea is actually super simple, right? So just, you start with break-even contribution, how much it is. You try to raise that price a little bit, reduce that price a little, just to match the actual price. You just make sure that you raise the apple price proportionally, you raise the banana price proportionally. That's what I do across different contracts. Right? The only detail is like, how do you parameterize it? What do you mean premium? Right? Proportionally additive, something. So the model in this paper we propose just to make some parameterization assumptions, a lot of assumptions to come up with this equation. Right? First, we'll assume that the risk neutral trend on the volatility equals to the physical expected trend plus the risk premium. The risk premium is proportional to volatility of that contract. I mean, it's just my assumption, right? So these are saying this is the volatility estimate. We'll assume it's proportional to the volatility estimate. Right? But I don't even know the trend forecast. Mean forecast is difficult. Variance is a little bit easier, right? Historical variance match future variance closer, but mean we don't know. Today's upward sloping, tomorrow downward sloping, we don't know. Right? So what do? We can set it to 0 if you don't know, right? That's actually many models that assume. Here we said, okay, I get a historical movement estimator, a trend estimator anyway. But then just let the market price to determine whether this beta should be positive or negative. If it's positive, I call that there is momentum. The market is pricing a momentum because I'm identifying things from the market. If this is negative, that means the market is pricing in a reversal. Right? So I'm not sure that's the way, but it's our assumption. And for return variance and implied vol variance, we just assume that the risk neutral versus statistical, they differ by proportional number, right? I assume it has to be positive, right? In theory. And I know under some measure change diffusion dynamics, they should be the same, but there could be a forecasting bias or some other dynamics going on. I don't know. We're just saying whatever the priced variance should be proportional to whatever the historical variance estimate, right? And then the covariance. Originally, I said, oh, covariance is the same thing, proportional. Then I realized covariance cannot be proportional because if the historical covariance is 0, then I cannot get a risk neutral covariance anymore by making it proportional, right? So now I make it proportional to the vol level. So in a sense, if risk neutral and statistical is the same, beta will be the correlation estimate, right? So in this way, it's a little bit more stable. But these are just very particular set of parameterization assumptions. You can figure out something differently. But the idea is just to add a common number per risk source. Right? And then if we go back to repeat the literature, right? So if you start with this jump diffusion stochastic vol models, this model can price the vol surface well if you make the model complicated enough. But the general finding is these models don't capture the time series variation of the option contracts implied vols very well. That's why risk management don't really use these models. I think many years ago, I remember Kelly Brown gave a presentation talking about, he's doing all this return distribution empirical analysis on options. The reason he's doing that is forget about these models don't work for that purpose, for the risk purpose, right? So that's problem is still there. And this historical top-down efforts normally assume some commonality on the dynamics, which is somewhat constrained, right? So this paper we don't assume commonality on dynamics. Actually, we take the dynamics as given as starting point, right? And then the centralization is not on common dynamics, but on common market pricing of different of the similar risk types, right? The risk can be different, risk manager can be different, but for the same type of risk, they should be priced similarly across all contracts. This is a sort of much weaker assumption. It's also a pure statistical assumption, right? Maybe some contract can be priced differently, persistently for a long time. It's possible, but it's more a statistical thing. It's that my Apple is different from your Apple. The Apple price can be different. Here, we're just assuming the Apple price should be close. If you're not close, then you can do set out and force them together. And so remember this model specification, this is based on remember I normalized the stock price, security price to 1. These are in the expected excess return space, right? So this is sort of in expected return space. But people are more familiar with implied vol. And for vanilla options, all these exposures are very analytical and it's proportional to cash gamma. So if I divide the relation by cash gamma, I get a representation in terms of implied vol. You have implied variance equals to historical variance times coefficient. If maturity is 0 and add the money, z plus is 0, then implied variance equals to historical variance plus a risk neutral adjustment. Right? Then along the maturity dimension, you have a term structure. The term structure is driven by volatility risk premium and your trend forecast. Right? You have a trend and the volatility risk premium that generates a term structure maturity. And along the moneyness, z plus, z minus, these are moneyness measures, you have a linear slope and quadratic term. Slope is guaranteed generated by the covariance, and curvature is generated by variance of implied vol. Okay, so remember in these things, the common coefficients, the yellow ones, they only change broadly the level, right? This one can make the level higher or lower, and this one can make the term structure steeper or flatter, and this one can make the smile still steeper and flatter. Right? But it's very broad, like a general adjustment. The fine details of the implied vol surface actually is controlled by these historical moment estimators. I think this thing doesn't change much. Return variance, I guess, is a one number, but this implied vol variance can vary across maturities and delta, and they can generate sort of impact, directly impact on the implied vol surface. Right. So the common pricing is more like a secondary adjustment. So how do you estimate this model? Simple regression, right? Why we use the negative theta decay, right? And the regressor X is just a bunch of Black-Scholes Greeks, Cash Vega, Gamma, Volga, and Verna. And each one is multiplied by the historical moment estimator, right? So we can call it the risk-adjusted exposure in a sense. And for vanilla options, these Greeks are all very tractable. And even for many exotic contracts, they are very easy to calculate, right? For barrier options, whatever, you can calculate them. So this pricing equation can be applied to both exotic and vanilla. But you just need to know these partial derivatives of the Black-Scholes model. Okay. And the slope estimates give you all these common coefficients. Under the null hypothesis of zero premium, zero prediction of trend, and a zero forecasting bias, then this is 0. This is vol premium. So that coefficient will be 0. This is prediction will be 0. This one will be 1 because you're saying historical variance equals to risk neutral variance, right? For these two. The last one will be the historical correlation estimate. Right? If I take the difference between the pricing estimate slope minus the vol value, and I call this the common market pricing of each risk zone. If the common market pricing is 0, by definition, I expect the contract to make 0 expected excess return. And if the pricing on this term is positive, I expect selling options to make positive return from that term, right? And if the coefficient on this one is negative, then I expect the option is priced as a discount from that contribution. Right? Essentially, I'm not talking about the one contract, but the contribution, 1, 2, 3, 4, 5 sources of risk, contribution to the price, right? And the market pricing tells you whether that contribution is above break-even or below break-even. Okay, we don't quite know the structural meaning, right? You can write a theoretical model saying why there's a premium, Here, I'm not saying anything about that. Actually, this estimate may not even be reasonable in whichever sense you are thinking about them. But if it's expensive, right? It's a direct comparison of break-even historical numbers versus actual price in one risk dimension, right? And the residual compares more like an idiosyncratic mispricing, right? This is pricing on each risk dimension, and the error is mispricing on one single contract after you adjust common pricing or mispricing on the risk dimension. So we did the analysis on currency options. Actually, we've done the S&P option for so long, and said let's switch, and it turns out it works out well. Later you see why. And Yuzhao actually did many currency pairs, but for easy to to do the presentation, we picked 2 pairs with the longest history. It goes to 1996. We have some saved data from earlier works, and then go to Bloomberg. Bloomberg is funny. They always keep about 10 years of history. I think 2003, when I was working there, I have 10 years of historical option data. Now I go back, I still have 10 years of data, so I need to save the history. Okay. So these are the time series plot. The yen is a little bit higher than pound, and it shows more variation across contracts. The pound is very interesting. Before 2008, it's virtually the surface is flat. Vol is low and the surface is flat. After 2008, the vol is much higher and there's some dispersions. And to see what those dispersions are, I draw the term structure, 12 months at the money minus 1 month at the money. So term structure mostly upward sloping greater than 0, but occasionally you have a short-term spike and then it's downward sloping. And for the skew, the red is pound. For the first 10 years, the skew is virtually 0 for pound, the red line. And since 2008, pound becomes pattern. It always had negative skew against the dollar in a sense, right? And the yen, interestingly, yen is always positively skewed since then. Okay, so that's the thing. So given this data, we need to construct a moment estimator. It's just important to realize that these are OTC contracts. So it's floating contracts, like one month. It's always 1 month maturity, but I need to calculate changes on the same contract. So I don't have the same contract over days, so I need to do some interpolation, right, to generate the same contract price change. And based on the same contract price change, I calculate returns on this variance covariance stuff. Calculate historical variance covariance over 1 month, 3 months, 12 months. This different historical moments tends to work better at different market situations. So what we did is we performed regression with each set of moment estimators and pick the highest R square one to say this is where market expected to be. Not sure it's fully kosher. The difference now. The main thing is if the different horizon, the term structure shape is different, and the higher performance matches market expectation of what the term structure looks like, I think. So this is the average term structure of the variance of variance estimates, different lines of the different delta. You can see that across different delta, the variance doesn't change as much, but across maturity, it changes quite a bit, right? From 0.45 to 0.1, right? So there's a steep term structure with some curvature for both of them. And this term structure is directly embedded into the term structure in here, right? In the implied vol surface here, and also in the curvature, smile and skew, right? And the drift, it plays a subtle role only on the term structure. It's more like compensation. So you can decide to set this to 0 if you don't want it, because without it, we'll just capture the term structure using the vol premium, right? With it, you get an extra term structure shape modification based on your forecast of the trend. So we perform this regression daily. It's super easy. So we do it daily instead of something monthly or weekly or something for 6,000 days. And here I calculate this thing. It's called the variance contribution. They sum to R square to give me a sense of the exploratory power of each component, right? It's less of a slope estimate, but more like a variance estimate. The strongest one is gamma. Gamma is the variance level term, right? Gamma explains 80%, the median, right? And the second term is vega. The vega is the term structure. So the level and term structure dominates. The the smile skew is smaller, right? The smile is 4%, skew is tiny. See, here skew is even negative, means they have some covariance with others. They're not contributing variance, they're hedging variance, right? So contribution is smaller. I assume maybe on stocks, when you have many strikes, maybe the skew smile contribution will be a little bit larger. For this data, the contribution is not small. And the R square is extremely high, right? You sum them together over 99%. This is on the return space. Remember, expected activity return space, 99% R square. I can convert them into an implied vol by dividing it like a delta method in the implied vol space. Then I calculate the mean absolute pricing error on the vol space. The error is larger for longer dated options out of money, right? The grand average is about 22 basis point on yen and 16 basis point on pound. I had a paper many years ago on stochastic skew on currencies. There I estimate these fancy geometry theory models, the pricing error is about 30 bips and 20 bips. So this model is much simpler and the performance is comparable. It's not better, okay? Even on the vol space. And these are the market pricing estimates for Vega and Volga, mostly positive for these two currency pairs. There are still some switches. For Gamma, it's more symmetric. Then more positive for yen, more negative for pound, right? Yes. And also you notice that there are some estimates that are outrageous. For example, for Vena and Volga, in principle, it should not be lower than -1. Because if it's lower than -1, the risk neutral variance estimate here would be negative. Risk neutral variance would be negative. But some of these estimates goes to -5. So these market pricing estimates are not always rational, even based on your model in your brain. We don't have a structured model, but even if you have something, it's not necessarily rational. Originally, I was trying to do a constrained regression to force some of these coefficients to be within a certain range. And then I said, no, why should I do that? Because if I do that, all I'm doing is to translate a mispricing in a risk dimension to the regression error, right? The regression error is mispricing on a single contract, right? So I would like to separate them. Whether these are market rational pricing or mispricing, I wanted to stay on that risk dimension. If this number you think is wrong, too big, too small, then it's a mispricing on that dimension of risk, right? Across all contracts, across many contracts, versus the pricing error, which is a sort of mispricing on a single contract, right? So without constraining the coefficients, I feel like probably I have a cleaner separation. These things don't affect my qualitative results very much, but it's more philosophically, how do you want to decompose this thing, okay? And the other nice thing about this is the model is linear, right? So which means it's very easy for you to form portfolios to hedge or target risk exposure because it's a linear structure. You can easily combo them. So if I define this exposure matrix in terms of the regressor plus the residual, right? You can form portfolios, right? You roughly generate this kind of regressions. So if you basically regress future returns on this matrix, it's like a return factor model. The slope coefficients will be the return on each risk targeted portfolio, which has unit exposure to one risk, zero exposure to others, right? And adding these will be like the set R portfolio, right? The first one is if I set target to 0 except the last element, then essentially I'm targeting to have one unit exposure to the pricing error and 0 exposure to all risk. So this is essentially the set R portfolio, right? You want to load up on error, you want to buy underpriced products, sell overpriced products while hedging away all the risk exposures. This would be that set R portfolio. So we calculate the return over the next business day, mainly because interpolation, right? So I tried to do this over the next week and next month. The results are still there. It's just a little bit weaker over longer horizons. So this thing is essentially fixed error by forming this portfolio. I also tried to do a renormalization. Each day I try to renormalize the weight to sum the absolute weight to 1. But I call that fixed notional. But either way, the performance is similar. The scale is different, right? The Sharpe ratio is about 5, 6. It's very high. Daily, granted, and no bid-ask spread stuff, right? No, these are over-the-counter contracts. So it just says the error is highly near reverting. Whether I can use it or not use it is a completely different issue. Okay, but we can also form this portfolio targeting each risk exposure, right, and heading away the others. So I call these risk targeting portfolios. Okay? And in principle, remember, if the market pricing is zero, the contract is priced based on historical moments, and they should break even, which means the expected return should be zero, right? So if the market price estimate is above zero, that means we should expect to make a positive return by selling that risk targeting portfolio. So based on this hypothesis, I run this regression. This is the risk targeting portfolio return over the next day. This is the market pricing estimate today, right? So there's no, and just check these things. Run the regression. The slope estimate is highly positive, right? These are the t values, 6 to 25, 11 to 20 for these currencies. The intercept are mostly insignificant with a few exceptions. Okay, so to visualize this, I did some local linear regression to see them. Okay, the circle denotes the center, that is zero risk premium. I should forecast zero return. Mostly it works out well, except for the gamma, I have a bias. Remember, the biases can come from several sources. One is when I do the regression to estimate the market price, and the market pricing can have an error, obviously. But that regression also determines the portfolio formation. That is, if my exposure estimate or my risk estimate is noisy, my risk neutral, whatever risk target portfolio composition can also be slightly biased. So I don't know what's driving this. This thing is quite persistent. It's always there. I feel like there is some identification issue probably that's driving that. But on these other risk sources, it's really centered around zero, which said, if my pricing estimate is positive, I sell it to make money. If it's negative, I buy it to make money. Okay? And I did one of those things. I call it harvesting time variant risk premium. Right? This is not based on forecasting regression. Right? Each you have an estimate. If it's positive, I sell. If it's negative, I buy. And I normalize them to notional and try to look at it around the median. Right? So this is why I said it's better. Actually, I choose currency options. It worked out well. Because for currency options, the market pricing estimates go over switch sign everywhere. So that means when I do the harvesting, I can long short. Right? If I do this on S&P 500 index, it works too. I can do the pricing. But for some risk, I forgot which one, maybe Vega. The risk premium is all highly positive or highly negative. So it's just the magnitude variation. Then this market timing is not helping you that much, right? If the market says you just need to sell options to make money, then selling a little more, little less doesn't really change your result that much. Here it changes a lot more because the market pricing actually switched time. Okay, let's see how the harvesting works. So these are just fixed notional short-ish risk targeting portfolio. For Vega, we're making money. For trend gamma, we're losing money. And for different currencies, it's different, right? So but if I do the market timing based on the market risk premium estimate, everything is positive. There's no estimation, remember. I know there's a bias, remember the gamma there's a bias, but I don't care about bias because bias is exposed to estimate, right? So if I don't estimate them, I just assume zero is my benchmark. So I can convert everything into this positive information rate. So that's pretty much the point. And this is sort of to me, this is the amazing component. Because historically, when I do option pricing, we are mostly doing risk neutral pricing. Sometimes for economists, we start with statistical dynamic classification, we specify market pricing of risk, but normally those things are very stylized. It's almost hand waving, right? We really want to get to the risk neutral dynamics to price well, right? So in my lectures to doctoral students, I said, okay, don't start with statistical. You can start with risk neutral to price whatever, make it work. And then you can specify whichever risk premium to generate statistical is almost separate, right? That thing. Here, I cannot be cynical anymore. It's not separate because I'm starting with risk neutral moments as my anchor of the model, right? And these pricing coefficients are whatever essentially captures the pricing deviation from my historical moments. And for whatever it's worth, this historical moment estimate seems to be a very good anchor in terms of where the zero expected return should be. If the price is above that historical moment, it's too high. If it's lower, it's too low, right? That's quite amazing. I'm thinking, can I do similar things on other asset classes, right? For stocks, can I do it? So that kind of thing, right? So I'm not quite sure. I feel like for it to work, I need to have something, you have to have well-defined observable risk dimension, right? This is all based on your specification or something. If you have well-defined risk dimensions, you can measure the risk exposure, you can estimate its historical variance, because variance tends to be stable. You don't need to forecast the mean, right? It's easier. And if the market pricing is switching sides over time, then it'll be very useful, right? If you say long equity makes money, then it's not helping you as much. If today you should long, tomorrow it's short, and somehow this pricing equation tells you whether you should long or short, I feel like that's a quite amazing implication, right? So it works out here. I'm not sure whether it works out in other classes, in asset classes, and in what way. I know for S&P index, for example, we tried this. The effect is not as strong because shorting the option gives you a sharp of 3 already. If you do the updating, it doesn't change much because ultimately you're still shorting because the market price estimate is negative, right? But if the market price estimate is swing a lot over time, then you get benefits. You're essentially having insight, right? So that's pretty much it. And the parameterization is sort of leave lots of rooms, right? This is how we started. And for different asset class, you try to find different modeling framework. For example, we were thinking of for stocks, for example, or should use the Black-Scholes model, or should Barclay even, right? So because this internal consistency is not less of an issue here because you are per contract. It's just a transformation. The question is which transformation better summarize the risk dimension and summarize it in the stable state, right? The yield to maturity is more stable than the bond price. Implied vol is more stable than the option price. Just that kind of transformation. And also given the price, there's some subtle details on which part is contract specific that you can estimate. And how do you add the common pricing? Is the additive or proportional to what? So I guess that does depend on some of economic reasoning sometimes, but there's still some leeways. And finally, for this paper at least, we did the expansion to the second order, right? Essentially, there's no price jump stuff coming in. In principle, you can do it, not higher orders. And I'm not sure it helps much for currency because my data is OTC. I don't 10 delta it goes to. But if it's for here, right? If it's for individual stocks, for example, and maybe the higher order price movements, which is a way of capturing skewness kurtosis. I remember some papers earlier presented here talking about the skewness kurtosis risk. Potentially you can do it, right? To the third order of DS, fourth order of DS, and you can see how the market is pricing the skew and kurtosis directly from the price. And then you can see whether these are priced in the returns. It's almost like a two-factor model. One is on the pricing equation. The pricing equation coefficient gives you the market pricing expectation. And then you can have a return factor model. And the coefficient is the exposed return on the risk targeted portfolio. And these two things, at least within my context, the pricing, ex-ante pricing forecasts the exposed return. Right? Whether this applies to other contexts, I don't know, but it's quite interesting to consider, right? Instead of considering return factor model by itself, consider sort of an analogous pricing factor model and the return factor model together. Right? So I'll stop here. Thank you.
Thank you, Liuren. I think it's time for questions. So if you feel like you have a question or just want to comment, feel free to unmute yourself and tell Liuren what you think.
So someone just posted one in the chat. So I'll just read it because it's a bit long to synthesize on the fly like this. So Tae Young says, sorry if I have an incorrect understanding for the concept. Is this approach working well for relatively short dated options I'm wondering it because for practical purposes, Greek decay and P&L attribution error over the day for short-dated option is relatively large, and so it would have a larger pricing error.
A very good comment. I haven't tried it. I really, really want to. Because during I think some of you guys write this paper on the weeklies, right? I really want to look into weeklies. These short-dated options now are becoming very popular, right? So the particular parameterization, what I have, I believe there are lots of limitations. I'm not sure it works, but the framework can work, right? So if you think of short-term mainly driven by price moves, forget about vol change because it's short, right? For one day, it's almost like a binary trade. But then we can still do this expansion. Maybe you just forget about the Vega term. Why don't you just do the price term, right? The second term, third term, and see which one is working. We can either calibrate it together with long dated or just short dated. It's just a regression. It's very easy to do, right? There is an issue. Say, suppose your option have one day, right? The implied vol may be becoming explosive for a jump sort of model. So maybe in that case, the black shows is not a good value representation. That's possible, but it's fine. You can find a representation that's better suited. Right? I'm trying to, let's see if we can have a model that prices like a binomial, trinomial for one step, right? For the short dated. And you can use that model as the starting point. You can do this kind of regression, right? So I never got the energy to look into it. I think somebody should too. I feel like this weekly option is so popular nowadays, and the dynamics should be quite different from these. But I've never got into it. I think it's worth doing, right? If somebody is working on it, I'm happy to take a look at your stuff. Two things, right? Even for the model representation, I'm not even sure Black-Scholes is correct, because I have a paper many years ago with Peter where we say that the implied vol becomes explosive for a process with jumps as maturity goes to 0, right? So, I mean, it doesn't go to 0. One day is a finite number. Maybe you get an implied vol of 100% something. It's like a yield to maturity also. It doesn't work that well for one-dated bond, right? Because the bond price within 1 day or 2 days is not sensitive or too sensitive to the yield anymore. So is there a better representation of the risk source? I think that itself is the important question. Can we get out of the Black-Scholes framework, right? Just to find a new it's just a representation anyway, right? To better summarize the risk source. And given that, you can still do this kind of pricing versus return comparison, I think. It's a very good question. I'm really interested in the short-term things, but I talk to students, but none of them pick up my stuff.
Well, thank you so much.
I have a question. So this is coming from India. So you compared Japanese yen with dollar. So this can be done for Indian rupee and dollar vis-a-vis?
Yes, you can do any currency. I think Yuzhao did about 5-10 pairs. The pricing performance is similar, but the sample size is different, right? The length is different. It's hard for me to present. But you can do it on any currency. Actually, if you have a Bloomberg, you can set up this very easily. Right? You have a spreadsheet file. There are not many contracts each day, right? These are OTC contracts. Set it up and load them in. It's just linear regression. It's very easy to do.
So can I get this data if possible?